Good morning, everyone. Thank you very much for joining me. This is the morning market review. It's Friday, the 5th of August, 2022. My name is Russell Shaw. I'm a senior market specialist at FXCM. My email address rshaw@fxcm.com. It's going to bring up our high-risk investment warning. Whilst I have that on screen, I'm just going to put the link for our NFP trade this afternoon. If anybody wants to join us and you haven't registered yet, I've put the link in our chat. All right, I'm going to just bring up our market commentaries disclaimer. And references Market Scope, Cnbc Trading View. What we'll do is we'll start off with the CNBC morning note, and it reads as follows: European stocks set for muted open. Key US job reports ahead. European markets are set for a fractionally higher open Friday as investors track corporate earnings and await a key US jobs report. Markets have endured a cautious week as investors reacted to a slew of corporate earnings. The Pan-European Stock 600 closed the previous session fractionally above the flat line. The Bank of England on Thursday hiked interest rates by 50 basis points while forecasting UK inflation to peak above 13% in October and the economy to enter a prolonged recession in the fourth quarter, which is quite an astounding statement to come out of the Bank of England. Friday's US jobs report due out 1:30 p.m. London time, 2:30 p.m. ZA time, and this is likely to offer clues about the Federal Reserve's monetary tightening path and the state of the US economy. Economists expect 258,000 jobs were added in July, down from the 372,000 in June, according to Dow Jones. Unemployment is anticipated to hold steady at 3.6%. Stock futures stateside cautiously higher in early pre-market trading as Wall Street looks to eke up modest gains for the week. Shares in Asia Pacific were mostly high overnight, with Taiwanese stocks leading gains in the region as investors shook off China's military drills following US House Speaker Nancy Pelosi's visit to Taiwan. Earnings continue to drive individual share price movements in Europe. Allianz, the London Stock Exchange Group, and a few others reporting before the bell. On the data front, French industrial output, trade balance, and current account figures for June are due Friday morning. All right. What I want to do is go to this. I'm just changing the template. This is what our Chinese analysts use overnight. All right. So yesterday we entered a sort of interesting sort of discussion. What goes first, the US dollar, or is it going to be the real interest rates? And I don't have a concrete answer, but what I did do was just take a look at the various theories around the term structure of interest. We're not going to get into the theory right now, but I think it's safe to say that there's not a hard and fast answer, Rob. So we've got something called expectation theory, and then within expectation theory, there are sort of sub theories. So you've got an unbiased expectations theory, local expectations theory. The idea is that the long-term forward rates are based on expectations. You've got something called liquidity preference theory, okay, which is effectively saying that the future spot rates plus a liquidity premium drive term structure. There is something called segmented markets theory, which we won't get into at the moment, and of course there's something called preferred habitat theory. So very sort of different theories on what drives your term structure of interest rates, which doesn't really solve our problem, unfortunately, but it does suggest that, of course, there is complexities involved. I would suggest there's probably elements of all of those, but it still comes down to what is happening with our real rates. We get a big clue today. We get a big clue today in the non-farm payrolls data. Let's just go through to, so this is the daily. What I want to do is just go through to the real rates on a weekly basis. And what we can see here is, let's just take the RSI out. Let's take out all the, indicators. Let's just look at this in terms of peak and trough analysis. And let's add in the US dollar. So very much a follow-on from yesterday's webinar, but I think it's tremendously relevant, because ultimately, I think this is the front line of the causality chain, right? So there's this whole lot of cause and effect that's flowing down, and I think we're right at this sort of front when we start looking at real rates. So what we'll do here is just bring in the US dollar as well. And of course, the way that the US dollar tends to move affects this chain of causality, right? So what affects the US dollar is the one question. And then the second question, of course, is, well, what does the movement in the dollar then suggest about other instruments? Gold priced in dollars, Bitcoin priced in dollars, right? What does it mean in terms of the majors? What does it mean in terms of importing, exporting, inflation? So we really, I think, at the front of the economic analysis when we're looking at real rates into dollar rates. Having said that, it's still not an easy analysis. The weekly chart for the dollar still very much in an uptrend. So let's just put our peaks and troughs in here. Let's start over here. Okay, so we'll just put in our reference trough. Here is the reference peak. And I would suggest we should be fairly strict here, okay? In terms of the peak and trough analysis, I'll show you why in a moment. Okay, so here's the higher trough, and here is the higher peak, and here is the next potential, okay, higher trough. I would suggest that this higher trough materializes. I would suggest somewhere along the line this probably does materialize. Where it gets gray or foggy is what happens after that. In other words, does the higher trough give us the next higher peak? Okay, which would have a very different interpretation to it than if it gave us the lower peak. Okay, so I think this higher trough we get at some stage just as a function of the nature of market movement, the peaks, the natural peaks and troughs, right? What's unclear is have we peaked in the US dollar? And there is, I'm finding it really difficult to get the, I guess, the relative strength between recession fears and inflation fears. That's effectively what is reflected in our real rates. Let's go now and add in our peaks and troughs for real rates. Let's be strict, okay? So let's go ahead and put those in. Let's start off over here. Okay, so once we've got the references in, we can see it's fairly easy to identify. Here is the higher trough, okay? Now, we're going to be strict here, right? We want to be strict here, okay? And here's the higher peak. Now, this is where it gets quite difficult. What do we have here? Do we have a lower peak followed by a lower trough, which would put the real rates in downtrend? And again, we're going to do this right according to the sort of textbook. So what we have here is an inside day. Let me put in an arrow so everybody kind of follows me. What we have here is an inside week. So this candle here is completely within that candle. So in terms of peak and trough analysis, can't really count it, unclear. Next candle, okay, outside period. In other words, this is completely inside this candle's range. This candle is completely outside of this candle's range. Can't really count it either, right? What's this one over here? This one is a inside, okay? And over here, we get the candle. It looks like it's moving up, but it's kind of within this inside, outside, outside, and then this one actually turns out to be inside with a higher peak. So this whole section here, very difficult to analyze on a very strict technical basis. So then what do we have here? We don't have the lower peak, but what we do have, okay, is a lower trough. Okay. So what's the point of being as finicky sort of as that? Well, if we had the lower peak followed by the lower trough, then real rates are actually trending down. So I'm going to take a stand and say we don't have that. What I will say though is that we don't have an uptrend in real rates anymore, because we don't have a higher trough followed by a higher peak. We've now got a lower trough that's locked in. It's very marginal. And how do we interpret that? Well, the real rates aren't moving up, okay, but they're not moving down. So we kind of we be calmed. You know, when those ships with sails don't have any wind behind them, they get becalmed. It's kind of how I feel actually with the markets, almost becalmed. What's the directional bias? And I can't tell because I'm choosing not to put this as a lower peak here, just because of the ambiguities associated. So the best I can come up with is we are neutral in terms of real rates. That's a problem. And for us as traders, that's a problem, because we're talking about a chain of causality. We're looking effectively at cause and we're trying to assess cause and effect. But if we've got a neutral sort of element right at the beginning of that chain, well, what happens when we ripple it out? It would suggest to me we're kind of at this neutral area where we are becalmed. And why do I think we becalmed? is because there is this tension. Let's just bring up Microsoft Paint. Is that what Powell was thinking? I wish I knew, Anna. I really wish I knew. But of course, we've got to, yeah, we've got to try and figure it out, right? So now we've got a tension. Now this is what's driving markets. Okay, the tension between recession risk and inflation risk. Okay. So let's just take a look at what we mean by that. Okay, so we have effectively a let's go back here. Let's keep the real rates in. Let's keep the dollar in, because again, I think this is really once these start moving, it flows through to the rest of the market. Easier for us as traders, right? Let's add back in at core PCE, okay, because that's really what the Fed's looking at. Yeah, let's put in core PCE. Now remember, this really doesn't give us much information, unfortunately. We've got to get the rate of change here. So it's pretty easy to do. Just right click, go to add indicator. Now, what I'm going to do, I'm going to keep this on the weekly. So what we'll do is we'll just use a 52-week rate of change. Okay, 52-week rate of change, just to get the PCE. Okay. All right, we can collapse this guy. So what we have here, okay, what we've got here is 4.79%, which is correct. And what we'll do is we want to put this 2% in. Okay. All right, so this is the first tension. Okay, this is the first part of the tension. Remember when I say tension, recession versus inflation. PCE is an inflation measure used by the Fed, and they want it to be at this red dotted line. So we are at 4.79. They need to get it at 2. By the way, when I say they need to get it at 2, that's not negotiable. They need to get it at 2. Okay. That's just a fact. They need to get it at 2. Okay, so that's the first. Unless they say, well, we're changing our target from 2% to 3%, but they won't do that, right? So they need to get this at 2, not negotiable. So that's the first part of the tension. Okay, second part of the tension. Here it is. Median. Sorry, not what I want. This one. Yeah, I'm begging your pardon. This is what we need. So this is now GDP. So this is economic activity, right? Let's bring that in. Okay. Let's give us some space. All right. So this is gross domestic product. Here is the lockdown period. Let's make this easier to see as well. Here is the lockdown period, and you can see how GDP is coming down. Okay. So now, what you have is a very, very tough spot to be in if you're a policymaker. You have to get your interest rates from 4.79 to 2%. You have to do it. But you've got this downtrend in economic activity. Okay, so let's bring up this. Let's bring this up in a set of axes. Okay, we're not going to talk about the supply side, but we need it for this discussion because we need the intersect. Okay, so there's going to be supply side factors, there's going to be demand side factors. The supply side factors actually look like there might be some easing in terms of price pressures there. Okay, let's just focus on the demand. Okay, let's just focus on the demand. Okay, so the idea here is okay, we've got an intersect there, and we've got an intersect there. All right, so what are we intersecting? Okay, well, we're intersecting inflation. Let's call it PCE, just to keep it with our analogy. PCE, and we've got GDP. Okay, so this is what we've got. So let's go back to our, here. So we've got 4.79 and we've got 1.6. So let's just put these numbers in: 4.79, 1.6, right? $4.79, 1.6. I'm extrapolating here to show, to make a point. The intersections over here, the intersection over here is not going to be as clean as this, right? This is a very sort of simplified theoretical model, but I think that the idea is 4.79, 1.6. And it's asking, why is GDP not minus? I thought second quarter was minus 0.2. So let me just clear up that we're not looking at it on a quarter by quarter basis, and we're looking at it on a year by year basis. Let's see if we can find the quarterly here. Here's the quarter by quarter, right? So this one should be negative, right? So let's add it in. Okay. What about done? I've clicked the wrong one. Let me try that again. Quarter by quarter. There we go. Should be negative here. There we go. Okay. So let's actually change this to a histogram. Be easier to see. There, that's a better way to do it. Where's 0? I don't have a 0, but you can see this kind of dotted line here. I'll put the 0 in. Okay, so there's 0. Okay, I've got too much red there, but I think you get the idea. Let's just make this thinner, and let's just make it black. Yeah, that will clear it up. Okay, there we go. Okay, so you can see we're negative. Okay, so minus 0.9, okay, on a quarter by quarter basis. So let's just get rid of that. Just let me know if that sort of clears it up. So the point is that GDP is contracting. You can see it on a quarter by quarter. We've got 2 consecutive quarters of contraction. But on a year by year basis, it's actually moving down, right? So now we've got to get PCE to 2. We've got to get it to 2. Okay, we've got the Fed is hell-bent on getting it to 2. They've told us multiple times through their representatives, the FOMC members, as well as on their statement last week, Wednesday. Go back to our, okay, let's put in 2% here. Okay, let's put in 2%. Okay. Now remember, the Fed acts on your demand side. Okay, not supply. The core PCE is all about demand. It strips out the supply side factors. Okay, so we want to get on a core basis from 4.79, we want to get to 2%. Okay, so let's take this through to our supply. So we need the intersect to take place here. Let's change the color up here. We need the intersect to take place so that we get our y-axis to 2%. Okay, let's do that. Okay, sorry, I not doing it particularly well. Let's do it again. There we go. Okay, let's relabel this. This is now AD2, aggregate demand 2. Okay, so now we've done the job. We've got from 4.79 to 2%. What's happening to our GDP intersection? Okay, GDP is coming in. Okay, so by moving to 2%, okay, by manipulating our demand curve, and how do we manipulate the demand? Through contractionary monetary policy, we move interest rates up. Again, best way to think about it is just in our own sort of consumption activity. On credit, interest rates move up, we tend to consume less. That means there's less demand pressures, shifts AD1 to AD2. We hit that 2%, but because there's less consumption, it means there's less economic activity on that thing, by that account. So we are making a bad situation worse on the x-axis. You guys see that? So we go back here. Okay, it means in effect we carry on going this way. Okay, that's the conundrum. That's the conundrum. So we have to get to 2%, but in order to get to 2%, we have to damage the economy. Paul Volcker did that, by the way. Okay, late 70s, early 80s, he did that. Okay, but I don't think, you know, I don't think that Jerome Powell's Paul Volcker. Now, that's very much the tension. So now we looked at the services PMI. Services PMI was strong. That to me suggests, well, okay, let's get to that 2%. Perhaps the shift on the x-axis has some sort of cushion to it. If we get a good jobs number today, then we would get a cushion to it. That means that it's effectively giving the green light to push towards that 2%. If we get a weak jobs number, That means that we don't have that cushion behind us. It's much harder to get to that 2% without damaging their GDP, without manufacturing, okay, without manufacturing that hard landing, okay. So you can see here's the tension. PCE is meant to be a PCE versus GDP. Now, what's included in GDP? What's included in GDP is, of course, the big one for policymakers: jobs. If you get your GDP coming in, well, jobs are going to be affected, and that's why the jobs report today is so important. But of course, all right, there's other ways that we can measure that, and other ways we've been measuring that is, of course, with the initial jobless claims. Let's bring that in. Let's just make space for it. So I know this is getting quite busy now, but we're getting, I think, a fair good picture here of what's going on. So let's bring in the initial claims. So this is a weekly number, so we can keep the scale as is. Let's just make this logarithmic bit easier to see. There we go. Let's make it again just easier on the R. Right, let's put in now our 3-month moving average. By the way, the reports that I was reading yesterday used a 4-week moving average. It's just to get a measure. There's no, it's just to get a, I like using a 3 months, so let's put in a 3-month simple moving average. Okay. Okay, that's fine. And you can see we're still above it. What's interesting here is that the moving average perhaps starting to flatten out. Again, that would be positive if you wanted to raise rates. In other words, you don't want your moving average to be moving up in that northeasterly direction. That's going to make implementing your tightening policy much harder. But I think the element that's missing here, just to kind of finish the analysis off, what's happening with the continuing unemployment claims? In other words, what we've seen is that, yes, initial claims are increasing, but the continuing claims haven't been as, I guess, as negative. In other words, people seem to be moving from one job to another fairly quickly. Let's take a look at that continuing claims to see if there's any deterioration there. Okay, let's go and bring that in. Okay, let's bring it up. Let's make this logarithmic. Okay, and again, just a little easier on the R. I'll make this one red again. And let's put in our 3-month moving average. And just check, yeah, that's fine. And you can see that the continuing claims is deteriorating, okay? So the continuing claims is starting to deteriorate, and we want to see if this moving average kicks up. Okay, so what's interesting, we've got a flattening of the moving average on the initial side. If that kicks up, negative, and we've got the continuing claims actually increasing, but we don't have the filter. We don't have the direction of the moving average kicking up. So again, what are we seeing here? I think we're seeing that that becalmed factor. We're kind of in between. What's going on here? Is the job market now really deteriorating to the point where if we push our price stability agenda, we're going to land much harder than we want to? Bank of England It's now factored in a recession, 13%. We're a global economy. I'm not sure how that doesn't have some sort of flow over effect. Perhaps the US more isolated sort of to the geopolitics of Europe, but there would still be some sort of flow there. So you can see that the job markets here are looking dangerous, but we haven't quite fallen off that sort of proverbial cliff edge, right? The GDP is a worry. If we're going to move down to 2%, this has to decline, but we want it to decline as flat as possible. Okay? We don't want a hard landing. We want this to be a flat decline. That's what the Fed is dealing with. That's what the market's dealing with. And let's just clear this up just to end off. That is where we find ourselves as traders, in that we do have a strong uptrend in the dollar, not so much so in the real rates anymore. And that means that we can now ask the question, yeah, we'll probably get the higher trough, but will we get another higher peak, or will we get a lower peak on the next leg? Because those have very different implications in terms of what's going on with rates. It means that the risk of a hard landing has actually won the day, or won out. If we see that higher peak, then I would suggest that inflation has won the order of the day. My expectation, my personal bias, or my personal opinion is I think that inflation is at levels that are teetering on real risk. I think that we need to get that under control as quickly as possible, but that's just sort of a personal opinion. By the way, it's very hard to trade with that kind of a bias, because this week in particular, I put on 4 trades. 3 were stopped, one was profit. So you can see the biases there flow through. All right, so I think we'll stop over here. If there's any questions, go ahead and type those in. Of course, we're going to do the trade later this afternoon, and everyone's obviously invited to that. No questions. All right, let's wrap up here, and we will meet 10 minutes before the non-farm payroll. All right, guys, speak to you later.